trying to time the market. And we talk about this all the time on the Get Ready for the Future show. And I think we talked about it already a little bit today, that equities are long-term investments. So everything that is going on in the world today with the tensions in Eastern Europe, with inflation at 40-year highs, there are always reasons not to invest when you see the red numbers for a length of time like we have in the equity markets in 2022. It can be very tempting to either park everything on the sidelines and not do it at all, or look for the quick hit, right? The big hitter that you're going to get rich quick. It's your lottery. It's your take it to the casino. But let's take a look at how chasing returns, John, is a dangerous game, especially if played with the money. I think there's a place for individual stocks in someone's portfolio, but it's not with the money that you're counting on using for retirement.
Well, and anything can do this, but we've got about 4 stocks here that we're going to talk about, and we're not endorsing these stocks. We're not downgrading these stocks by any stretch of the imagination. This is just factual of what has happened. Pardon me. Peloton in 2020 was up over 434%. In 21 and 22 is down 82%. If you look at Zoom, it was up 396% in 2020, but it was down in 2021 and 22 by 66%.
A couple of more. Pinterest, that's one I used to spend a lot of time on, and apparently a lot of other people did in 2020. It was up 248% then, and then, 254% then, and then in 2021 and 22, it was down 60%. And then Square in 2020 was up 248%, and then in 21 and 22 was down 36%. Now, the reason that we're showing this, as John said, it's not that we have anything for or against these particular stocks. We just want to show you that rear view mirror investing is not wise. So if you think about if you were driving in your vehicle down the interstate, and instead of looking out your windshield and looking forward and periodically looking behind you, instead of doing that, you only looked in your rearview mirror. You've even got something to block the windshield where you can't see in front of you. That would lead to some pretty bad disasters pretty quickly. There's no way that you would drive that way. And we would propose that you should not invest that way either. The phrase is, past performance is not indicative of future results. Yeah. By the time you hear about this thing is a big hitter, you're pretty late to the game. You're buying high.
Right.
Well, and let's boil it down to this. If you have to react to something to think you're going to get financial independence, you're probably going to be wrong.
Yeah.
And usually, as you said, Janet, the bloom is off the rose by the time you hear about it, because the gains, obviously, in these companies all were done in 2020, but they weren't so fortunate in 2021. So if you look back at the start of 2021 at the past performance of those stocks and went, wow, those are great, I'm going to buy into those, then you would be disappointed at this particular point in time based on where you got in at. So you've got to look at this and go, okay, is there a methodology to what I'm doing? Because you don't get rich quickly in the stock market. You get rich slowly, and you have to have a systematic methodology for doing that. And that's why financial planning is important. That's why having a financial coach is important, because that coach will help you to stick to that methodology.
Want more content like this delivered to your inbox weekly? Visit fastest4.com to learn more.